Okay, good afternoon, and thank you for joining. Um, Thank you for attending the second part of the Philanthropy Educational Tract. My name is Kieran Leva, Senior Financial Consultant and Partner at Seneca Lyons and Associates, Private Wealth Management. Our family office provides comprehensive and complete financial planning services to successful business owners and professionals, as well as to high net worth families with complex financial planning needs. The Philanthropy Educational Tract is designed to provide insights to help high net worth families understand and plan ways to implement their desire to give back to the community or create a long lasting legacy. The first installment of the series aimed to highlight important aspects of gift planning with the aim of leveraging government support through tax credits and deductions. The second installment and today's presentation builds on the first session and will look to add more strategies to help meet your goals of giving back. A couple of notes before we begin. Our live presentations are interactive, so we encourage you to use the Q&A function at the top of your screen if you have any questions. We'll get to as many questions as we can at the end of the presentation. And if we can't get to yours, we'll follow up with you with a response and share the offline question with the other attendees if it's general in nature. If it's more specific to just your situation, we're happy to reach out to you directly. Finally, a bit of a disclaimer, the contents of today's presentation are meant to be conceptual in nature and should not be taken as specific advice. Any of the strategies outlined here today would need to be considered in the context of your individual circumstances and may or may not make sense or be applied to your situation, depending on the specifics. So everybody's situation is different, and that needs to be taken into account when coming up with strategies. Before we dive into the agenda and begin the presentation, I will take a moment to explain how legacy planning and sharing your wealth fits into a financial plan and our process for working with clients. Legacy is a specific component of a financial plan, but it's not in and of itself a financial plan. Saying I want to give X to charity through my estate is a nice sentiment, but if your retirement hasn't been tested to ensure its success, your estate may not have enough to meet your charitable goals. What if my investment returns is not what I expected? What if inflation is higher in retirement than forecasted? What if I get sick and can't work if I haven't yet retired? So one of the core principles of our family office is that financial planning should be comprehensive and consider the various relevant factors of your financial plan in conjunction with one another. To ensure that our clients' plans are successful, we do take the time to understand the variety of factors that will play a part in their financial situation. So whether that's managing your cash flow, planning a major purchase like buying a home or a cottage, preparing for an unexpected event like death, disability, or critical illness, reducing your tax burden, and planning or transitioning into retirement. We work with our clients to ensure that they understand how each of these factors impacts one another to ensure a cohesive plan that creates certainty in all areas of their financial plan exist. They're really at the center of everything that we do for clients. What further distinguishes our family office is the inclusion of family members in the planning process, often providing financial information to our clients' parents and children, and preparing financial plans for their benefit as well. So on to today's topics. Quick agenda for you guys. So I'm going to be going over a quick recap and some of the main takeaways from our first session before handing it off to Pierre for him to go over some of the other topics that you see on the screen. At the end, we're going to kind of wrap it all together in a case study so you can see how some of these strategies can be applied in actual examples. So on to the next slide. In our experience, many people think that charitable giving is about saving money. The truth is that giving to charitable organizations can save you income tax, but never to the extent that you give. You'll always be out of pocket when you donate to charities, despite the tax incentives. Rather, philanthropy is really about wanting to give back or to create a legacy. In the first part, I'm going to fly through a few concepts that we discussed in our previous educational tract. Feel free to see our installment or the series on our websites if you want to review some of these concepts in more detail. I think the website is on the next slide. Yeah, at the bottom there, it's www.senecalliance.ca/video. You can find our first tract as well as other webinars that we've put on in the past if you'd like to take a look at that. So a quick recap. So we went over why you may want to consider donating to a charitable cause, the qualified donees or the recipients of your charity, taxation and philanthropy and how those two intertwine, and the different ways that you can give. So in our experience, individuals that are looking to make a charitable donation don't give for financial or tax-related reasons as their primary driver. The reasons differ, but at the end of the day, it's about giving back to causes important to them and supporting their community. So one of the things that we're going to review quickly is the charitable donation tax credit for individuals. So in any given tax year, the first $200 of charitable donations that you claim on your tax return is at the lowest tax rate of your territory. Today, we're going to look at Ontario, which is a combined rate of about 20%. So donations in excess of 200 provide a higher tax credit rate. So that can range, if you're earning about $91,000 or more, it can range between 40% and 48%, depending on your taxable income. So the charitable donation tax credit is a non-refundable credit. You can donate if you're really aggressive in a particular year to reduce your taxable income by up to 75%. I can't do any more than that in a given tax year. Something to be mindful of is that these charitable donation tax receipts can be carried forward for 5 years following the year of donation. So this is important because if you're saving or not saving, sorry, if you're donating to a cause that's important to you and you're doing it on a monthly basis, for example, it may be worth it instead of claiming the donations, or sorry, the charitable donations every single tax year, to maybe do it every 5th year and combine them all together. That way, less of your donations are getting that 20% rate that we took a look at and getting more of that 40 to 48% on the previous slide. So if you're a couple, you can decide if you want to attribute your donations across both of you or combine them onto one. Ideally, you'd want to combine them onto one and have that person be the higher income earner in your household. Finally, looking at charitable donation tax deductions for corporations. In the previous example, individuals get a tax credit, whereas corporations get a deduction from their taxable income. In our first section, we kind of went through the math on this, but the conclusion is it's better used against investment income than business income. And like an individual, a corporation can carry forward unused portions of their donations for up to 5 years as well. All right, so with that, this takes us to our second installment of the Philanthropy Educational Tract. And presenting this section will be Pierre Senecal, Executive Financial Consultant and Senior Partner at Senecal Lyons and Associates. Pierre has decades of experience as a business owner in the fields of manufacturing, land development, construction, and of international trade and finance. Pierre specializes in providing advice on financial, tax, and estate matters to our clients. So in addition to being a CPA, Pierre holds many industry-leading designations, including his Certified Financial Planner designation, his Trust and Estate Practitioner designation, and his Chartered Life Underwriter designation, making him one of the top planners in our industry. Relevant to today's contents, Pierre is also recognized as a Master Financial Planner in Philanthropy and a member of the Canadian Association of Gift Planners. So you guys are in good hands, and with that, I'm going to hand it off over to Pierre. Please take it away.
Well, thank you, Kieran, and thanks everyone for tuning in. For our clients who have a desire to share their wealth with their community, we pride ourselves on preparing and implementing plans to give that are completely harmonized with their overall family and business financial plans. Here are a few strategies we've implemented over the years for our clients. So a question we often get by professionals and business owners who happen to have a corporation they're working through is, should I give through my corporation or personally? Well, obviously the answer to that is, it depends. And basically it depends on the type of corporate income your corporation earns. Is it business income? Is it investment income? And also your personal marginal tax rate, or if you prefer, your tax bracket. In the example we have here, your private corporation has $20,000 in cash that it wants to pay in dividends, and you want to give $10,000 to your favorite charity. The corporation, in this case, earns investment income, and you're personally already at the top tax bracket in Ontario. On the column on your left, your corporation makes the gift, the $10,000, then pays a dividend with what's left after the corporate tax savings. And at the end of the day, after you pay your tax on the dividends you receive in the corporation, you end up with $7,800 or thereabouts in your pocket. On the column on the right, the corporation pays you the whole $20,000 dividend, and you make the donation personally. You end up with about $5,200 to $5,300 in your pocket. In these circumstances, obviously, it would make sense to give through your corporation and avoid taxes at the higher dividend tax rate in your personal tax return. This is an annual calculation we make before year end with the clients who are planning to give. So when you have investments that have grown in value, it now makes sense to give them in kind, basically, which means that you would give your shares or your mutual funds directly to the charity. So selling securities in order to raise the cash instead, to make a charitable gift and trigger capital gains, and resulting in a percentage of the gain included in your taxable income. So if you sell to create the cash and give the cash, you might have a tax liability. However, since 2006, the Income Tax Act provides that donating a publicly listed security directly to a registered charity is more tax advantageous, since you don't have to pay tax on any portion of the resulting capital gains if you give it directly in kind. That is, the inclusion rate would be 0% rather than 50% taxable. So when receiving your gift in kind, the charity issues a tax receipt for the fair market value of the investment. Publicly listed securities could include stocks, bonds, mutual funds, ETFs, and segregated fund policies, or if you want, mutual funds issued by insurance companies. So in this case, it might make sense to give your investment as is to your charity rather than selling the investment and paying the capital gains tax. So in the example we have here, a $10,000 in-kind donation has an $8,000 embedded capital gain. Over and above the charitable tax credit of $4,800, the donor would avoid in Ontario about $2,100 of tax just on the capital gains, which would be 50% of the $8,000 at the tax rate of 53.5%. The net out-of-pocket cost of his $10,000 donation to the charity, so they would get the $10,000 in their bank account, but it would cost the donor only about $3,000 out of their pocket. In the case of an Ontario company, a small business, so Canadian-controlled private corporation, tax rate on investment income, called passive income, is just over 50%. The charitable tax credit is therefore $5,000 or thereabouts. The capital gains tax would have been $780, the net tax payable, for a total tax savings of about $5,800 for the corporation. Plus, this is a good part, the non-taxable part of the capital gains could be the subject of a tax-free capital dividend to the shareholder, which would normally be $4,000. But in this case, because the whole amount of capital gains is tax-free, then the whole $8,000 could be sent tax-free to the shareholder, which would give you at the top rate an extra $1,900 of savings in your personal tax return. Now, a note here, not all charities, especially the smaller ones, are set up to accept in-kind donations. We'll be discussing a workaround later in this presentation on how you can still go ahead and do that. Now, a lot of people also talk about giving their RSP or their RIF to their favorite charity. We see this mostly in their will. Anytime you withdraw from your RSP, or when you pass away, you're deemed to have withdrawn everything, it creates a taxable income. So when Ontarians die, a huge chunk of their RSPs and their risks may end up being taxed at over 53%. Please see our estate planning webinars on our website for more information on this. So giving your RSP to charity while alive or at death also creates a taxable income for that day. However, giving your RSP to charity creates a charitable donation tax credit for an amount of the donation, negating a huge part of the tax bill. Although most people who choose to donate to their RSPs or RIFs do so at death, but it could actually be done when you're alive if it makes sense. So at death, you can name your estate as the beneficiary of the plan and make a bequest or donation to the charity in your will, or you can name the charity directly as a beneficiary with the plan issuer. In both cases, it's very important to record the proper legal name of the charity when completing the designation of beneficiary form, since many charities have similar names and very many charities have chapters in different towns or cities. So if you don't really zoom in on who it should be, there might cause problems there. So either way, a donation receipt is issued based on the fair market value of what the RSP or RIF was worth when it transferred over. The executor also has the flexibility to use all or a portion of the receipt donation when filing the terminal or estate tax returns. You know, there are many tax and estate planning issues to consider before electing to name a charity as your beneficiary through your will. It's best to sit down with a financial planner to discuss all the implications. So many people use life insurance policies to provide a huge donation, often a legacy for their favorite charities. You know, at this point, I'd like to introduce to you to Ty Werenberg, our team's insurance and estate planning specialist, to discuss strategies involving life insurance.
Good afternoon, folks. Okay, so I'm going to chat a little bit where life insurance can fit in with regards to planning on your when we're looking at charitable giving. And a lot of people may not have thought about using insurance in this way, but it certainly is something that can be used. First, let's talk about donation limits at death. Because life insurance can provide a very large lump sum when you pass away, it may exceed the 75% of your income in that year. In fact, it could be many multiples of your income in that year. So there are some provisions in there that do permit for you to give more. You can give up to 100% in the year of death, and you can make that charitable donation within 5 years of passing, or your executor certainly can. And you can also go to the prior year's income. Now, there may also be cases where if we give a death benefit to a charity, it may exceed both of those amounts. And I know that James is going to talk about some strategies a little bit later on how you can address that. So next slide, please. Okay. So what we can do here is there's two ways of addressing this. One, you can give a policy to the charity directly, or you can give the death benefit to the charity. And there's very big differences on where the tax deductions or the tax credits come in. If you were to give a policy to the charity right now, you're giving up ownership, but what happens is I get a deduction on the premiums that I put into the policy each and every year. So this is important that I have my deductions today on an ongoing basis. Giving the policy to charity makes a lot of sense, and it does allow for tax savings right now. Do be aware that when you transfer the policy, if you have a new policy, you can go out and apply for a new policy and you can then give it to the charity. Do be aware that if you apply with the charity as the ownership initially, there's some couple of complications with that. So we usually recommend sitting down with us just to talk about the best way to approach that. However, you may also have an existing policy, and that existing policy you may not need anymore. So you may be interested in, or some people think about canceling the policy, but we often recommend, why don't you donate it to a charity, because the charity will give you a donation credit for either the cash surrender value or the fair market value of the policy. And when I say fair market value of the policy, what I mean is if you have a policy that has no cash, but you've been paying into it for 20 years and there's a death benefit of, let's say, $500,000, there may be an intrinsic value there of $200,000, for example, and you can actually donate that policy, have it valued for $200,000, and actually have your receipt made up for the $200,000. You do have to be aware that when you give to the charity, that first of all, the charity, if it has no cash value in it and you're not planning on making future premium payments on that policy, that the charity would have to agree to accept the policy because they would need to make subsequent premium payments. However, if you are planning on continuing to pay the premium on the policy, then the charity is usually happy to receive that. But the other thing that happens is when we give a policy, especially one that has a cash value, we have to realize that there's a deemed disposition of that policy. And when I say deemed disposition, that means that there may be a taxable gain on the policy when we donate it if there's a sizable cash value in the policy. Now, that's usually more than offset by the charitable donation, but it is something to note that there is going to be a deemed disposition. Still, it's a great way to give something to the charity now. They recognize what they're going to get in the future. They know there's a future death benefit. Last point on that, though, if there is a sizable cash value, it is possible that the charity may decide to cash the policy in because they need those funds sooner. So just be aware that once they become the owner of the policy, they actually can control the fate of that policy to a certain degree. Next slide. Jump to the next slide. Here we go. The other way to do it is to name the charity as the beneficiary. This is where we're giving at death. Usually the charity is unaware that it's coming unless you let them know in advance that you will be giving them the death benefit. So this goes back to, and by the way, you can change your beneficiaries if you want. You still have control of your policy because you haven't received a charitable donation yet. You can also, if you decide not to give to that charity or the charity no longer exists, you can also have that money then redirected to a new charity, or it can be redirected to family members if you wanted to. But naming the charity as the beneficiary allows you to have control. The only difference is you're not going to get any tax deductions on the policy until, or tax credits on the policy until passing, and then it's going to be in the estate where we're getting those tax benefits. So that would just sort of give you a little bit of a high level view of what insurance can do for you with regards to charitable donations, because what it does permit you to do is usually we're putting considerably less into the policy than what the death benefit ends up being. So it usually allows us to multiply the amount of money that we're actually giving to the charity by using the life insurance. And now I'm going to pass, I believe James is going to jump in here and start talking, or Pierre.
All right, thank you, Ty. That was very informative. Ty is part of our team, and when we look at all the complex insurance strategies, for which there will be webinars coming in the next few months, Ty will be instrumental in that. So, onward with this. So another strategy I just wanted to touch upon, which is reserved pretty much for very high net worth people and very high earners, buying and donating flow-through shares. It's a complex and specialized strategy, typically, like I said, aimed at high net worth people. Under the strategy, donors could end up getting up to 90% of their charitable contributions back in the form of income tax benefits. So what are flow-through shares? Well, flow-through shares are normally issued by exploration companies in the mining or oil sectors in Canada. Now, these companies have been spending a lot of money exploring initially in the first years, and they are allowed to flow their tax-deductible exploration expenses in a given year to the owners of those flow-through shares. like I said, they do so because they already have a large accumulated tax loss from the past, and they can't really use these deductions for years to come. Because of the tax benefit, they're actually able to issue the shares at a very, very large premium or a high cost, because it's just makes sense financially for everybody. So under this strategy, donors could end up, like I said, getting 90% of their charitable contributions back in the form of income tax benefits. So on the day the donors purchase a large amount of flow-through shares, they donate some of it to a charity. In the same day, a third party purchases the shares from the charity as well as the additional shares that the donor kept, thus eliminating the risk of holding shares in risky companies. The donor receives the flow-through tax benefits from all of the shares that he or she has initially purchased. So this strategy works for high income earners who can wait for their refunds to be received after they receive they file their tax return. For example, for a $100,000 donation, that might end up costing up to $10,000 from the donor after all the tax benefits have settled, but the donor might be out of pocket for up to $360,000 until the tax return is reassessed. So people who can cash flow and wait for the money, but they would get most of their money back. Again, this is for very high net worth people who are looking to give a substantial amount to charity. Now, one last item I'd like to talk about is the donor advised fund. So basically, because foundations, that's the way you want to go, they're an expensive and time-consuming structure. More and more we see Canadians turn to donor advised funds as a great alternative to leave a long-lasting legacy. So a donor advised fund is similar to a private foundation, in that just like a charitable foundation, the full contribution to the fund provides a charitable donation receipt in the year the donation is made to the fund. Anybody could donate to the fund, although there are usually minimum donations of a few $100s. And just like a foundation, the client who initiated the account, or the families or successors, decide annually who will benefit from a portion of the invested funds. For example, 5% of the capital value of the previous year end is given every year in to a charity of their choice. Now, obviously, as the funds are invested and they grow and you give 5% a year, those funds can last for a long time. And for a small annual fee, the cumbersome reporting and time-consuming regulatory compliance that you associate with a private foundation is handled by the fund administrators. So the donors are really totally free from those burdens. It's actually that easy. So many high net worth and successful business owners use a selection of annual recipients as a way to get their kids and their families involved and aware of giving back. They like the educational value of the event and the family harmony it helps create. For business owners, donor advised funds avoid tax complication arising from the ownership of both private foundation and a private corporation, especially if the private foundation owns shares of their company. It's not an issue with a donor advised fund. Finally, many charities are not set up to receive investments in kind. We talked about that earlier. Most donor advised funds are set up for the in-kind donations. So that becomes a convenient and easy way to donate in kind to the donor advised fund, and then directing the final donation to your favorite charity, especially when they are not set up to do that. With me here. So IG has a charitable giving program, and it's available through the IG Strategic Charitable Giving Fund. For example, we have set up the Seneca Alliance Charitable Giving Fund a few years back, and every year, as a team and in discussion with clients, we give annually to local charities. So now let's put it all together. James Lyons is a senior financial consultant with Seneca Lyons and Associates. He holds the Certified Financial Planner and Chartered Investment Manager designations, as well as being recognized as a fellow of the Canadian Securities Institute. James will present a quick case study representing a real-life situation. Take it away, James.
Awesome. Well, thanks, Pierre, Ty, Kieran. Appreciate the wealth of knowledge that the three of you shared here. So let's get into a little bit of a case study here and see some of these strategies in action here. So we're going to talk about Andrew Jones today, who's an 87-year-old retired Ontario business owner. Andrew earns a significant income. He's earning $320,000 a year through various pensions and investments. And in addition to that, has a growing $6 million investment portfolio. A few years back, Andrew set up his donor advised fund through IG and called it the Jones Family Charitable Giving Fund. And each year he gets together with his kids, his grandkids, and great-grandkids to select recipients of the Charitable Giving Fund. Every year, and as Pierre alluded to earlier, while you're living, you can contribute 75% of your taxable income to a charity and receive tax benefits. So every year he's elected to do so. Having ensured that his children are well looked after, Andrew's desire is to give his portfolio to the Charitable Giving Fund when he dies and leave an intergenerational legacy. So let's look at how Andrew's currently looking to execute this strategy. So of course, he's already donating 75% of his income to charity each year, as Pierre alluded to earlier, that in the year of death and in the year prior to death, you can claim up to 100% of your taxable income as a charitable donation credit. So when Andrew passes, his executor would top up his year prior to death from the 75% all the way to the 100% to get that additional deduction there. So in Andrew's year of death, taking a look at his portfolio, the taxes on different RIFs, capital gains, whatever the case might be, his income in the year of death is going to be about $1 million. And his income in the year prior to death is about $320,000 as a typical year for him. So when his executor files the income tax returns, they would be able to claim about $1.1 million of charitable donations on the tax returns in the year of death and the year prior to death. Of course, looking at the numbers, however, there's a significant sum which would be donated to charity, as is Andrew's goal, that would not provide tax savings. So when we're working on a situation like this, we would suggest strategies that, while accomplishing the same goal, might actually optimize the tax savings from said donations. So what we suggested for Andrew's consideration is that in his will, he instructs the executor of his estate to contribute as much as possible to cover the 100% of his taxable income in the year of death and in the year prior to death. Once the estate has settled, the residue of Andrew's estate, so what's left over after he does the charitable donations in the year of death and the year prior to death, the residue, the remaining amount, would be transferred into what's called a testamentary trust. And if you want to read into testamentary trusts a little bit more, again, please reference our presentations on our websites on estate planning. But again, the residual amount would be transferred into the testamentary trust. And the beneficiaries of said trust would be Andrew's children, their children, and any future children from subsequent generations, as well as the Jones Family Charitable Giving Fund. With this structure now in place with the testamentary trust, every year the trust could distribute enough to each of the children of Andrew to cover 75% of their taxable income. And the recipients would agree to direct the trust to direct their distribution to the Jones Family Charitable Giving Fund. With this strategy, his children, their children, and the future generations will barely pay any income tax for years to come, while also accomplishing Andrew's goals of creating a lasting legacy through charitable donations. So again, going to just put a pin in that there. It's a bit of a complicated strategy. If you're interested in learning more about strategies like this, again, please do reach out after. And if you have any interest in estate planning in general, please do reference the estate planning webinars on our website. So that's going to be it for the case study today. I'm just going to plug right now that we are going to be taking questions at the end of the presentation. So if anything's come to mind, please use the Q&A function in the chat to put those questions in there. And if they're general in nature, we'll be happy to address them. If they're specific to your circumstances, we will get in touch afterwards. So maybe while we work through it here, just a few final thoughts on charitable donations, philanthropy. For many of our clients, philanthropy is about giving back and enhancing family harmony. We hope today that we've shown how a bit of planning could enhance your tax savings and support your desire to give back to the community. Just some high-level points here to keep in mind regarding, reducing income tax liabilities, donating shares in kind to avoid the capital gain, gifting a life insurance policy when it's no longer needed, or if you want to give a substantial amount upon your death, a variety of different strategies that could be utilized in your philanthropic goals. So again, thinking about getting started on your philanthropy plans, most of our clients who are interested in philanthropy have worked hard to get to where they are, and may be thinking about the best way to share their wealth at this stage. Again, we don't use charitable donations just for the tax benefits. You give because you're a giving person, and that's a desire that you have. Although if that is a desire that you have, giving to charity should be something that's planned like all your other finances to get the most out of it. Again, when I look to buy an investment, of course I want to, buy into companies that, I believe in their mandate and, the services they provide and things like that. But I also want to, maximize the benefits from it as well. So kind of a similar example in the charitable donation world. But again, a carefully constructed giving plan will help you create the legacy that you're looking for, and help you look after causes that you care about. And keeping in mind, you don't need to wait until death to donate. You could give during your lifetime to maximize tax benefits and, see the impact that your charitable foundation or your charitable donations do have. Okay, so while we gather the questions here, if you'll indulge me for a minute, I'll just take a little bit of time to talk about our team, the services we provide, and how you might work alongside Seneca Lyons and Associates. So you've met our advisory team here with Pierre, myself, Kieran, and Ty. We're supported by an amazing client servicing team as well, who make our client service level second to none. In addition to our team at Seneca Lyons and Associates, we are part of the IG Private Wealth Management Department, which is supported by some specialists in various different categories. You'll see here Christine von Kauenberg literally wrote the book on financial planning in Canada. She's our head of financial planning. And then you'll see Jack Courtney there, very prestigious and reputable individuals in the business who are part of our team to support us with, complex planning. When it comes to the offering of our team, we provide comprehensive and complete financial planning services to successful business owners and professionals, as well as high net worth families that have complex financial planning requirements. You'll see here on the graph in front of you that we like to think of ourselves as part of your A team here. You're at the middle of everything we do as our client. When you retain our team, you're also, of course, getting access to the IG Private Wealth Management experts, as well as all of our preferred partners for banking, investments, mortgages, insurance, whatever the case might be. But you'll note on the side here that we've also got your personal advisors here. And I think it's important to note that, again, we're looking to be part of your A team. We're not looking to replace anybody. So when we work with our clients, often we'll work in conjunction with their accountants, their business advisors, their realtor, their lawyers, whatever the case might be. often the strategies that we will suggest or their other trusted partners will suggest for our clients will involve, a level of communication between different professional advisors. And I always like to suggest to my clients that, hey, look, I'm not looking to replace anybody. I want to be part of the team and make sure that what I'm suggesting is aligned with your other professionals to ensure that you're accomplishing your goals in the most effective way possible. Just gathering the questions here. Looks like we've got a couple for you, Pierre. So let me just read through them here. But just kind of finalizing the thoughts on our team here. Again, when you retain our team as your financial advisory team, you're at the center of everything we do. And we make a commitment that, we want to help you meet whatever goals you have, whether that's, family financial goals, business financial goals, charitable financial goals. We commit to keep you informed as things develop with your financial plans and provide the level of communication and service that you would expect from a family office. So I talked a lot about our team at Seneca Lyons and Associates. We fall under the banner of IG Private Wealth, which is one of the biggest asset managers in Canada. We're actually going to be celebrating our centennial anniversary next year, so 100 years of servicing Canadians. And again, IG Private Wealth Management as an organization focuses primarily on financial planning. And we are part of the Power Corporation of Canada group of companies. You'll probably recognize some of our sister companies with Wealthsimple, Canada Life, so on and so forth here. IG's partnered with a lot of the biggest and best in different industries in order to provide our clients with the products that they need to meet their financial goals. So again, whether it's mortgages, lines of credit, life insurance, private investments and infrastructure, private credit, private capital, public investments. IG's gone out into the market and partnered with the biggest and best in their industry to ensure that our clients have the products that they need to meet their financial goals. And finally here, before we get into the question, just a quick comment on IG's charitable impact. Of course, this is a philanthropy-based presentation, and IG has put its money where its mouth is, so to speak, has committed to giving back to causes all across the country, in particular being the title sponsor for the Walk for Alzheimer's in Canada. In addition, our team, I think Pierre alluded to this earlier, has created our own charitable giving fund, through which we continue to support local charities each year. This year, we are supporting Diabetes Canada towards paying for a local child summer week at Camp Haronda to help that child learn how to cope with that chronic disease. Okay, so coming back to the questions here, Pierre, I'm going to bring you back on for a couple of the questions here. So the first one here, let me just read through this, is, okay, so Pierre, we talked about making donations to registered charities, whatever the case might be. Would a family be able to combine the donations with a spouse, a child in a calendar year?
Okay, Kieran actually mentioned that for spouses, you can combine them, and it actually makes sense to combine what you can because you eat up that first $200 a year. That does not produce a huge benefit, but everything else does. So by combining them, you only have to deal with that $200 low-paying fruit once. However, you cannot. You can share with your spouse, but not with your children. So your children would have to do their own charitable deductions. At that point, they can't be combined.
Excellent. Okay. Thanks for that, Pierre. So I got a couple of more questions here for you. What are the costs for establishing and managing a donor advised fund?
Oh, good question. So with the IG Strategic Charitable Giving Fund, there are no setup costs whatsoever. So if you decide you want to put $10,000 into your new fund, the $10,000 is invested and given to the fund. You get that as a tax receipt, and the money is now what is ready to be given from there on. However, there is an annual fee at 0.55% of the value of the fund per year. And when you think about it, for just over half of 1% of what you have in there, you don't have to handle setup legal costs. You don't have to do annual audits or annual accounting. You don't have to file any reports and make sure that you're aligned with everything. You don't have to keep track of what's been given and who's so the people we work with handle all that for you for a small fee of 0.55% a year. If you had a private foundation, you'd be paying many times that amount. So we think it's a good deal if you're going to go that route.
That sounds like a pretty good return on your investment in terms of
Absolutely
managing administrative costs. Okay, just keeping an eye on the time here. I'm going to give you one more, Pierre, and then maybe we'll break after that. So in the case study, we talked about Andrew Jones and the testamentary trust and the the plan for his family to essentially get together each year and instruct the charitable foundation on what to do. Who decides on what the recipient charity is in that situation?
Well, obviously it was a family decision, but the person who made the call was Andrew at the end of the day while he was alive. Now he passed away. So there are a few options when you set this up, and even after it's set up. You can name what we call successor holders. So on mine, when I pass away, I might decide that my children now, or one of my children has the final say and gives the instructions. Now, again, what Andrew has asked for in his will is that his children and grandchildren still get together to decide as a family, just for the benefits of the family harmony and getting people sensible to all that, sensitized to all that. Now, he could have set up that, every year it's going to go to this charity, no questions asked, at which point there is no decision to be made. And in our case, to be blunt, what he decided is no, every year the families would get together and one of his grandchildren actually would be the spokesperson for the family. In the same sense that in the will, when he created his testamentary trust, in his case, he named two of his grandchildren, adult grandchildren, obviously, as the trustees for the testamentary trust, and that those children would then have to every year before year end get a sense of how much income the children and grandchildren are earning. So there could be a charitable, or I guess a disbursement from the trust to that specific child to cover 75% of their of their income that would be given directly to the charity. Now, just a point to add here that we should have mentioned is that you're allowed 75% of your income to get a charitable deduction, right, or a tax credit. But you can give more than that. You just don't necessarily get the tax benefit. So if they should have been paid $30,000 and you paid $40,000 by mistake, the good news is that additional $10,000 could be claimed in any one of the 5 next years. So if you give too much, you have 5 years to use up that over contribution if you want. So that deduction or that credit could be claimed over the next 5 years.
Right. Similar to, if you were to put too much money into your RSP in a given year, you don't have to claim the deduction that year. You can carry it forward.
Bingo. Same thing.
Excellent. Okay, we got one more question that's slid in here at the end here, Pierre, and then we'll probably conclude the presentation. When you donate registered funds, so your RSP, your RIF, whatever the case might be, do you have to donate it in kind? So do you have to send the shares in as shares? Do you sell the investments? How can you operate in that type of donation?
Okay, so this is sort of different than if you're giving from your investment account, in the sense that you can give them in kind, but you can also sell all the investments and give it in cash, which is probably what the what the charity would prefer. And from your perspective, or from the estate's perspective, because you're inside an RSP or a RIF, you don't pay tax on capital gains anyways. And you're paying the tax when the fund leaves, when the money leaves the RSP or the RIF. So whether you sell the funds or the investments before or not won't make a difference. So most people actually do not give in kind when that happens. They say the beneficiary of my RSP is either my estate handles it, or it's, make it up, the Red Cross of Canada. Make sure you're specific there and not a region, if that's what you want. And then the funds are sold and the money is given directly to the charity without any taxes withheld on those amounts.
Awesome. Thank you for that set of answers, Pierre. So I think that's going to conclude the questions here. So if I may, before we conclude the presentation here, you would have seen just on the screen there that we have some upcoming webinars for the rest of the year. We look to do these every 6 weeks or so. Again, as Kieran said at the outset, looking to provide timely educational content for our clients and the public here. So you'll see some of the different presentations we've done in the past there, whether it's for the business owner, Tract, charitable giving, Tract, estate planning. So all of these previous webinars are available on our website at senecaalliance.ca/video. For the rest of the year, we do have a couple of more presentations coming up. You'll see that we've got estate administration just before Thanksgiving, and then insurance as an asset class in November here. So if you found the content today interesting and are interested in those subjects, please feel free to register, and we'd be happy to host you. So once again, want to just say thank you to Pierre, Kieran, Ty, all our presenters today. Thanks for all the attendees for making the time to learn about this important subject here. If you are interested in more content from us, we do post educational content on our website, again, senecaalliance.ca, our Instagram page, things like that. So if you want to keep up to date with different content, please follow us on our different social pages. And if you are interested in learning more from us directly, feel free to book a meeting with us on our website. We'll be happy to address any concerns or considerations that you might have. With that in mind, I think we're going to go ahead and conclude today's presentation. So again, thanks everyone for attending. Thanks you to the presenters, and have a wonderful afternoon.
Thanks all.